We haven't seen this since the 2008 financial crisis. Something big is happening in real estate financing right now that smart investors need to understand because it's going to create a lot of opportunity in both 2025, 2026, and beyond.
In today's episode, we are pulling back the curtain on financing strategies that are completely changing the game for real estate investors right now.
If you're looking to maximize your leverage, which you should, minimize your down payment, which is a pretty good idea, or just get creative with how to finance your next deal, this is an episode that you can't afford to miss. See what I did, Dan? You can't afford to miss it.
Yeah, it's good. We're going to cover everything from vendor take-back mortgages that sellers are suddenly offering everywhere to how you can tap into government programs that many investors don't even know exist.
The market is evolving so fast, and investors who understand these financing options will have a massive advantage over those that don't, or those that are still stuck using conventional methods.
So whether you are a seasoned investor or just getting started, hit the subscribe button, leave us a like, comment, or a review depending on what platform you're watching this on. Check out realestate.ca if you want to join our free meetups, our online investment mastermind and group coaching community, which now has a $100 a month group coaching option since we're completely sold out on one-on-one coaching for at least the next 2 quarters. And let's break down the financing strategies that will define real estate investing in 2025, Nick.
Let's do it, Dan. Welcome back to the Canadian Real Estate Investor Podcast, where in today's episode, we're going to be exploring the most effective financing strategies for real estate investors in 2025. While the market continues to evolve and these new programs emerge, understanding your options has never been more important.
So the key topics that we're going to overview today are, number one, vendor take-back mortgages, VTB financing strategies. Number 2 is CMHC's MLI Select program. Number 3 is the Canadian government's secondary suite loan program. And number 4 is the owner-occupied high-value property financing, which is up to 90% of $2 million loan to value, which was supposed to start in January of this year, although we've heard very little about it. We did a little bit of research that we're going to get and present. And one of our panelists at our upcoming event is actually going to be basically researching it for the next month and calling all of the banks to figure out their programs on it to present that at the event. So we're going to do a quick overview of each of these for those watching on YouTube, and then we'll dive deeper for the full podcast episode.
So let's start with the real estate investing strategy that you need to know, especially in a recession, Dan. And you just said it, it's VTB's vendor take-back financing. And if you've been a long-time listener, you have heard us talk about this before. If you follow us on social media, you know that we have spoken about this and that we love utilizing this type of financing. This was a huge thing back in the 90s, during that 90s downturn that we've also spoken about in this podcast. And guess what? It's back. Okay. The nostalgia from the 90s isn't just movies and much music. It is now VTBs. Vendor take back financing is creating massive opportunities for smart investors this year. There are more MLS listings offering to finance their properties than ever before, Dan. Is that correct? Because that seems kind of crazy.
Yeah, it's true. So we basically built a tool to scrape all of the listings that are available for VTB for our website, valerie.ca, the AI brokerage that I'm a chief real estate officer at now. And that as well as power of sale listings. So you've got 2 pretty big recession indicators from my perspective, but also opportunity indicators that are flashing red. So VTB financing is when the property's seller acts as your lender, offering part of the purchase price as a loan. It's a game changer in today's market from my perspective.
For sure, man. And the benefits are substantial. You get more levers to pull when negotiating in your deal. It's less impactful to your credit bureau, which for some investors and self-employed people can be a bit of a battle. And guess what? You don't have to qualify through a bank. You get more flexible terms than traditional financing, which is one of the barriers to entry that most investors can't figure out how to even get in or bypass even after a few deals. And this means you can get into properties, here's a good thing, with significantly less time and energy, and in some cases less money as well.
Yeah, I think the money part is rare, but if you have a seller who really believes in the value of the property, sometimes they'll let you go to a high loan to value ratio. Or one of the strategies we're going to talk about later is blending some of these things together, like using a VTB as a bridge, which we've seen quite a bit.
Hmm.
So let me walk you through a quick example here. So imagine buying a property, a $1 million property with just 20% down. The seller provides the remaining $800,000 as a loan at 5% interest for 5 years. This arrangement benefits both parties. As a buyer, you secure financing that might be difficult to get traditionally. As a seller, you get tax advantages by spreading the capital gains over multiple years, plus steady income from interest payments, and you get to sell your property, which was obviously your original intention for listing it, I would hope. And so we're going to break it down a little bit further afterwards. So stick with us here. But VTBs are essentially powerful in a couple of different scenarios: vacant land, commercial property purchases, high interest environments, unique properties, markets where we're seeing a capital contraction like the one we're in right now, where banks are afraid to lend, but sellers still want to keep the deals going, and so they'll lend to you. Properties where the structure is in such bad condition that a bank won't even finance it. That's one of my favorite applications of a VTB. It's sellers
Yeah.
selling the property. They're like, oh yeah, you should be able to, it's like, okay, well, if you want me to buy this off of you, I can't get a bank to buy it. I'm not going to buy it cash because, people don't really do that in this market. Realistically, I'm competing with a bunch of non-cash buyers. So why don't you lend me the money, Mr. Seller? Yeah.
Yeah, I love that, and Dan, we've both had experience over the years, whether it's us purchasing through our small fund, or whether it's advising clients of ours on how to structure VTB. Where some of the properties we've seen over the years, I remember one specifically. It was literally, it looked like someone had a campfire in the middle of the living room. There was another one where the roof was falling in. There was another one that was so remote, and it was like a commercial residential mixture that had like an industrial kitchen in it, that also had like an RV and boat storage place in the back. And lenders get scared with that type of stuff. And that's where properties like this thrive, if you can figure out how to pitch and negotiate a VTB. But you also have to understand the risk. Sometimes higher interest rates mean your property must generate sufficient cash flow, and you need to requalify for new financing when that VTB term ends, because you still need a term and a contract and conditions with whoever's holding that mortgage for you. Now, in 2025's challenging market, a VTB could be your key to unlocking deals that others might just not be able to access.
Yeah, we actually had a student who literally just listened to our first episode about VTBs, did a bunch of research, got a lawyer, like we mentioned, who could execute these types of things, got a real estate broker who understood them, and they bought 3 of them last year.
Yeah.
Like, sometimes all you need to do is ask, right? Or in this case, since they're listed on MLS and stating that they're willing to lend a vendor take back mortgage, you just need to find them. And we can talk a little bit about that. I mean, for the GTA, if you have a realtor, you can just ask them to search in the broker remarks for terms like VTB or seller financing. But we also have a tool that's built where you can basically subscribe. I'll put the link in the show notes, actually. I'll send it to you. But that, I mean, again, you can get these listings, and if you're outside of the GTA, just ask a realtor. Typically, like, sellers will put VTB either in and you can actually do it on realtor.ca as search terms, but people are less likely to typically put it in the public comments. They're more likely to typically put it in the private comments that only realtors can see. So ask a realtor if they can search for VTB or vendor take back financing, and there might be a little bit more sellers offering it privately than ones who are actually offering it publicly. We found, at least in the GTA, it's about 50-50. So you get about 50% of them who you can see it in the public comments. So if you just search on realtor.ca, you'll find 50% of the properties that mention VTB in their public comments, but then there's about double as many, like 2x in total, where they're offering a VTB more privately in the broker remarks.
Very interesting. Okay, so while we're on the subject, Dan, of VTBs, because this is such a hot topic right now, let's just keep doing a bit of a deeper dive here. I'm going to start at the very top here, and we've already kind of answered this, but we're just going to define it again. What is a vendor take-back mortgage? Well, that's a financing arrangement where the seller of a property becomes the lender for the buyer. Okay. Now, the seller essentially takes back a portion of the purchase price as a loan to that buyer. So, Dan, why don't you tell me how a VTB would work in reality here?
Yeah. So basically, the buyer just makes payments to the seller similar to the way they would with a traditional mortgage. Interest rates are set by the seller and agreed upon by the buyer, or they would set that through their negotiation process. It can cover various amounts. So, it could include some of the closing costs you could bake in or a significant portion of the purchase price. And I would say it typically has a higher interest rate than traditional mortgages because it's, the seller's basically giving you a private mortgage. So in a
Mm-hmm.
lot of cases, they will often expect a higher than average rate to compensate for the risk. However, if the seller's really motivated and they really want to get a deal done, they just want to dispose of the property, they don't want to own it anymore, maybe they'll be willing to make some concessions on the rate as well. I mean, when we're in a buyer's market, the buyer's probably more in control of the rate and they're going to get a more favorable term. When we're in a seller's market, the sellers are probably the ones dictating the rate and the terms, and so they have a little bit more control over the pricing. They have a little bit more pricing power, I guess, in that regard.
Yeah. Okay. So that's great. So while we're on the topic of buyers and sellers, why don't I talk about the benefits for sellers and you can talk about the benefits for buyers? Because people who are listening probably thinking, why would someone do this? How would I negotiate? If I'm a buyer pitching a seller, if I'm a seller, being one of those many people that are listing stuff like that right now, why would I do this? So the benefits for sellers, well, they can help you close a deal faster in a challenging market. They have potential for higher returns through those potential higher interest rates that were negotiated. It can be a good investment strategy for a seller, almost paying out like a dividend stock for the duration of that agreement. And again, they may offer tax advantages, not tax advice. Please consult with a tax professional. I am the worst at this stuff, but it can have an effect. And then more so overall, if you're that seller with that dilapidated property that is going to be very hard for anyone to purchase in a conventional way, this has got your name written all over it.
Yeah, I would agree. In a lot of cases, it allows you to get the sale. Plus, you can make some income off of the interest. And again, you mentioned there's a capital gains reserve. Ask your accountant about that if you're a seller, because it can be a really good way. I mean, so many real estate sellers hate capital gains, right? Like most real estate investors hate capital gains. People are super afraid of it, even more so now with the increase in the inclusion rate.
Yeah.
Ask your accountant if this is a good strategy for you to offload some of your portfolios. I mean, we've got some members even of the course who've said, like I've spent my whole life building this portfolio. I would love to be able to hand those assets down to another investor, and just make I own them outright. I would love to be able to make my 5% interest on that, on my portfolio and just sell these off to a buyer who might have a hard time qualifying otherwise, right? And I'll just become the bank. And they're probably only making the same return on all their equity in there anyway. Like most properties
Mm-hmm.
are, 5-7% cap rate. So if you're all cash in the deal, you might as well just convert it to debt, right? Become the bank,
I like
and give
that.
it
It's
off.
got a nice ring to it. Become the bank.
Yeah, yeah, for sure. I mean, if you think about that, the Kiyosaki, like uh, that cash flow quadrant, right? Like really the only way to move to that fully passive piece, one of the only ways is to become the capital, right? To have a
100.
capital only relationship with the asset.
Yeah. 100%. And we just talked about that in our last episode, which is real estate investing actually passive, or how to achieve
Yeah.
passivity through real estate investing. And again, that's kind of real estate investing final boss. You know what I mean? You've kind of made it to the end of that gamified journey,
Yeah.
where you can become the bank. But we've digressed. Dan, tell me about the benefits for a buyer here.
Yeah, I think the primary benefit for a buyer is it's an easy qualification process compared to a lender. You're typically not providing a ton of paperwork. They're not underwriting your income as much, and it's not to say that that's like some sneaky way of getting it. It's just the primary security is the property, right? Like the seller, if they're selling their property and they've set a price on it, they clearly believe in the price of the property, and it's a really good way to sniff test whether or not they actually believe in the value of the property. So
Mm,
the primary security is the property itself, and then your vision of what you're going to do, how you're going to get it, so that RBC will come and take out that loan in 2, 3, 4, 5 years, whatever your term is. Um, This can be especially helpful for those who've been declined by traditional mortgage lenders. I see it a lot with people who are trades contractors who are flipping properties. They'll go and find the worst properties. And this kind of leads me to the next point. It can be really helpful for properties that are difficult to finance conventionally. So distressed properties, properties that need a ton of work, that are basically dilapidated, that need that contractor to come in before an RBC or EQ bank or somebody will lend on it. And then you also have potential for more flexible terms and conditions, right? And it introduces another lever, those terms and conditions, the interest rate, the length, the loan amount, all of these, your amortization schedule, all of those things are now new levers to be introduced into the negotiation process.
Yeah, I love that. Okay, so why don't we run through? We just did buyers and sellers, the advantages for both. Why don't we run through some common scenarios for VTBs, right? And we've